What's up, everybody? Today we are diving into all things money and finance. I am going to be covering two chapters in this video, chapters 15 and 16. They are both about money and finance to some degree, and so they kind of go hand in hand, so I'm going to tackle them together today. But I'm going to get started with chapter 15, which is all about understanding money and financial institutions. And I'm going to kind of start. I try to pick things out of the chapter and go in somewhat of an order to make it easier for you all to follow. So, starting in the beginning of chapter 15, it talks about just what is money. And I will say that a lot of us are probably familiar with at least the majority or a good part of the terms in chapter 15, but it will help us kind of relate money to organizations. So it talks about, money, what is it, the characteristics and functions. And so money is anything that is accepted as payment for goods and services. So back in the day, we know money as like dollar bills or just bills in general, $5 bills, whatever, and coins. But, back in the day, money could have been cattle or salt or things like that. But when we think of money, we think of that stuff we can put in our pockets, which is what money is today. But anything that can be accepted for goods and services. So for money to be suitable for a means of exchange, it should be scarce, it should be durable, it should be portable, and divisible. So easily divisible, as far as that's why we have ones, fives, tens, 20s, etc. So money functions as a medium of exchange, a standard of value, if you will, and a store of value. So the United States money supply consists of currency, again, coins and paper, money, our demand deposits, so your checking accounts, and time deposits, so your interest-bearing deposits that can be not withdrawn on demand. So a lot of the savings types accounts or the accounts where you just can't take money out just freely would be more of those interest-bearing deposits, as long as it also is bearing interest, but most of those are. And so it kind of introduces you to the, what money is and some different characteristics, and then how the Fed, or the Federal Reserve, also known as the Fed, and that's how you'll probably hear me refer to it as, manages the money supply. So the Fed, or the Federal Reserve, is an independent government agency that performs four main functions, all right? Carrying out our monetary policy, setting rules on credit, distributing currency, and making check clearing easier. So the three tools it uses in managing money supply are often the open market operations, a reserve requirements, and the discount rate, okay? So the Fed played a major role in keeping the United States financial system solvent during the financial crisis of 2007 to 2009. So if you were, old enough to even be aware of that recession, then you kind of know what I'm talking about. But they did this by making more than $9 trillion available in loans to major banks and other financial firms, in addition to bailing out the auto industry and other companies and supporting congressional, passage of the Dodd-Frank federal legislation, if you will. And so there's a lot to that they do that we don't really think about, and how they manage money and making sure there's enough but not too much, because if they put too much money out at one time, then money's not as valuable, and so forth and so on. All right. So it talks about the key financial institutions and what roles they play in the process of this financial intermediation type thing. And so financial institutions can be divided into two main groups: depository institutions and non-depository institutions. Depository institutions include commercial banks, which we are all very familiar with, thrift institutions, and credit unions, okay? Non-depository institutions include insurance companies, pension funds, brokerage firms, and other finance type companies. So financial institutions ease the transfer of funds between suppliers and demanders of funds. All right. So a lot of us have heard of the FDIC. If you own any kind of checking or savings account, I'm sure you have at least heard the term. The FDIC, the Federal Deposit Insurance Corporation, is who insures our bank accounts. But they insure deposits in commercial banks through the bank insurance funds and deposits into thrift institutions through the Savings Association's insurance fund. And then deposits in credit unions are insured by the National Credit Union Share Insurance Fund. So this is administered by the National Credit Union Administration. So the FDIC sets banking policies and practices and reviews banks annually to ensure that they operate fairly and profitably. And so that, again, the FDIC insures the commercial banks, the thrift institutions, and the National Credit Union Share Insurance Fund does the credit union. So those are kind of two different ones. Again, they insure, and I believe the FDIC now is they insure each account up to $250,000. It was $100,000 for many years, and they changed several years ago to $250,000. So that's why typically people don't have more than that in one account. You need to spread the funds out if you have enough money to do so, or more money to do so. But U.S. banks provide loans and trade-related services to foreign governments as well, and foreign businesses. They also offer specialized services such as cash management and foreign currency exchange. And to kind of end chapter 15 and kind of wrap it up, it talks about some different trends within the financial institutions, and just the banking industry really continues to change. So several trends are influencing the future of our financial industry, including a continued focus on regulatory and compliance issues, as well as operational efficiency and technological advances. If you've heard of fintech or financial technology, so the same thing. But fintech services will continue to really disrupt the banking industry and provide opportunities for banks and other institutions to really work closely with fintech companies that can really help them innovate and just continue to grow their businesses and just have that strategic advantage. You want to have, there's mobile apps is one big one. I don't know if you all use online banking. I'm sure a lot of you do. And if you have the mobile apps on your phone, a lot of people only use the mobile apps. So they will continue to be a strategic advantage that really separates traditional banking approaches from innovative companies that really can offer clients a connected digital experience when it comes to their money and investments. And a lot of people want that connection, right? And we know that now you go to the bank, you don't even have to go to the bank to deposit check. You can do that all via your mobile app by taking a picture, et cetera, which has made it super convenient. But having that constant connection is still important because it is people's money, right? And people really care about their money. So you need to have that keep that piece of it. But you'll just see that the next, years, we'll see actual banking branches become less prevalent, and you'll see more and more online and mobile services, obviously, because they just become more and more popular, right? So people are going less and less to the bank. With that, I'm going to pivot into chapter 16. So understanding our financial management and securities markets, all right? So chapter 15 focuses more on money, and chapter 16 focuses more on investments, for lack of better words, if I just wanted to sum it up quickly. It starts at the beginning of chapter 16 by talking about, how finance and the financial management and the effect of the firm's overall strategies. So finance involves constantly, managing the firm's money. So when it comes to finance, that's pretty much what it is. The firm, how the firm manages its money, and it's constantly evolving. So the financial manager really must decide how much money is needed and when, how best to use the available funds, and then how to get the required financing. So the financial manager's responsibilities include different things such as like financial planning, investing, so how they actually spend their money, financing, raising their money, all right? And things like that. So maximizing the value of the firm is the main goal of the financial manager, whose decisions, often have those long-term effects. So just in short, to sum that piece up, when a company has made money, we don't want it just sitting in the bank. We want it to be making more money. So that financial manager will decide, okay, we need this much to buy assets or, for those operating expenses. They have to figure out how much, that's where accounting comes in, how much money the firm needs to actually run. But with those profits they are making, we don't want them just to sit in the bank. How can we invest them to make more money? So that's the financial manager's goal there, is to how are they spending the money, investing, in how are we raising money. So it talks about short-term and long-term expenditures that the firm can make. And so a firm incurs short-term expenses, so your supplies, your inventory, wages, etc. And then the financial manager manages the firm's investments in current assets, all right? So that the company has enough cash to pay its bills and support accounts receivable and inventory. So you want to make sure that you have enough money to actually run the business, all right? Pay the bills and do all of that. But your long-term expenditures, so your capital expenditures, are made for fixed assets such as your land, your buildings, your equipment, your IT or your information systems. And because of these large outlays, if you will, required for capital expenditures, financial managers have to carefully and very carefully analyze proposed projects to determine which offer makes the best returns, okay? So again, trying to figure out how we can make the most money with what we have. And so it talks about the main sources of and cost of unsecured and secured short-term financing. And I'll go through the difference real quick. So short-term financing comes due within 1 year. So that's a short term. And then the main sources of unsecured short-term financing are your trade credit, your bank loans, and commercial paper. Secured loans require a pledge of certain assets, all right? So unsecured, meaning you don't really have anything behind that loan. Secured assets mean you have put something up, and if you default on the loan or do not pay your loan, you're going to lose whatever you have put up to back it up. So secured loans require a pledge of certain assets, such as accounts receivable or inventory, security, like a security for the loan. So factoring or selling accounts receivable outright at a discount is another term for short-term financing. So when you go to get a loan out, and I don't know if you've heard people say that, oh, they've put their house on the line or whatever, you don't really want to do that, because if some reason you have to default on that line, on the loan, the bank takes your house. So just kind of something to keep in mind as you're kind of reading and processing it all. But then it goes in to talk about the difference between debt and equity. And so it talks about how financial managers must choose the best mix of debt and equity for their firm. So, what we own, what we owe versus what we own kind of thing. And the main advantage of debt financing is the tax deductibility of it. So being able to deduct it on your taxes of the interest. Okay, so you can deduct the interest if you own a house. You can deduct your interest on your mortgage. If you pay a school loan, you can do the same, stuff like that. So, but debt involves financial risk because it requires the payment of interest on a principal on specific dates, all right? And so just kind of like when you're making loan payments. Equity, so think like stocks, common stock, preferred stock, is considered a permanent form of financing on which the firm may or may not pay dividends, all right? So dividends are not tax deductible. So the main types of long-term debt are term loans, all right? So loans with certain terms attached with it, bonds, and mortgage loans. So term loans can be unsecured or secured. So having something backing it up or not, and generally have maturities of 5 to 12 years is that average range. And then bonds have initial maturities of 10 to 30 years. And mortgage loans are secured by real estate. So if you default on your mortgage loan, you lose your house. So that is the secured, that is what is backing that loan up, is your house. If you don't pay it, the bank takes your house, or whoever is you have your loan with. So long-term debt usually costs more than short-term financing because of the greater uncertainty that the borrower will be able to make the scheduled loan payment. So just to kind of recap that real quick, if you have a loan that's a 3-year loan, okay, 3 years is not really a huge, that's even shorter than most car loan payment times, if you will. And so there's a good chance that, you know, you will probably be able to make those payments if you were actually approved for the loan in that shorter amount of time, versus like a mortgage loan, which is average 30 years. You know, you have 30 years to default on that loan. So the risk is greater there, because how do they know? Sure, you might be in a great financial position now, but they don't know where you're going to be in 30 years. So that is why there's a greater risk to longer term loans. And so then it talks about, you know, when and how do firms actually issue equity? You know, what are the costs that are associated with that? So it talks about that the chief sources of equity financing are common stock, retained earnings, and preferred stock. And the cost of selling stock includes issuing cost and potential dividend payments. So retained earnings are profits that are reinvested in the firm. So if the firm makes a profit and then they reinvest it, those are what we call retained earnings. So for the issuing firm, preferred stock is more expensive than debt because its dividends are not tax deductible and its claims are secondary to those of the debt holders, but less expensive than common stock. So venture capital is often a source of equity when it comes to financing for younger companies. Then it kind of goes into you know, securities markets and, you know, how they help firms raise funding. And so securities markets really allow stocks, bonds, and other securities to be bought and sold quickly at a fair price. So new issues are sold in the primary market, and then after that, securities are traded into the secondary market, all right? So investment bankers really specialize in issuing and selling new security issues. So stockbrokers are licensed professionals who buy and sell securities on behalf of their clients. And in addition to corporate securities, investors can trade U.S. government treasury securities and municipal bonds, mutual funds, and other options as well. So mutual funds are managed by financial service companies that kind of pool funds of many investors to buy diversified portfolio of securities. So if you have like an IRA or anything like that, like retirement funds, a lot of times there will be some mutual funds within there, and it's kind of a pool of different investors, and it really just helps you diversify your investment portfolio, if you will. But they also talk about EFTs, all right? So ETFs, I'm sorry, EFTs. ETFs, so exchange traded funds. And they are like mutual funds, but trade on stock exchanges that are similar to common stocks. So it talks about how futures contracts are legally binding obligations to kind of buy or sell specified quantities of commodities or financial instruments that like at an agreed on price on a future date. So they can be very risky investments because the price of the commodity or financial instrument may change drastically. But options, are contracts that entitle the holder the right to actually buy or sell specified quantities of common stock or other financial instruments at a set price during a specific or specified time. And so in your book, it talks about common stock and preferred stock. Um, and so it's good to kind of know the difference between the two. Preferred stockholders usually have a preference in their dividends, and common stockholders do not, but common stockholders have voting rights. So those are two main differences between the two. So going into like where investors can actually buy and sell securities. Securities are resold in what we call secondary markets, which include both broker markets and dealer markets. So the broker market consists of national and regional securities exchanges, such as the New York Stock Exchange, which I'm sure everybody's heard of, that bring buyers and sellers together through brokers on a centralized trading floor. And then dealer markets use sophisticated like telecommunication networks that link dealers throughout the United States. All right. So if you've heard of the NASDAQ, NASDAQ, the NASDAQ and other over-the-counter markets are examples of dealer markets. So if you watch the news ever, a lot of times, especially if it's like primetime news, it'll show the results of the day from the stock markets, and it'll have the Dow and the New York Stock Exchange and the NASDAQ. So now you kind of know the difference. But in addition to broker and dealer markets, electronic communication networks can be used to make securities transactions. So in addition to the U.S. markets, more than 60 countries have the securities exchanges like that. All right. And just some fun facts, and it mentions this in your book, that the largest non-U.S. exchanges are the London, the Tokyo, let's see if I can remember, Toronto, Hong Kong, Taiwan, and there's one, Frankfurt, I believe, which is in Germany, exchanges. All right. So outside of the U.S., those are the larger ones. And the Securities Act of 1933 requires disclosure of important information regarding new securities issues. And so in your book, it talks about the Securities Exchange Act of 1934, and then it had an amendment in 1964, and that formally empowered the Securities and Exchange Commission, the SEC, not to be confused with sports, though. Granted it broad powers to kind of regulate the securities exchanges and those dealer markets that we talked about. But that's just kind of some of the FYI you may or may not need to know that in the future. But I always think, the more you know, the more you know. But kind of to wrap up chapter 16, it talks about, what are some current developments, and it mentions that the role of the CFO, all right, so Chief Financial Officer, has continued to expand since the passage of the Sarbanes-Oxley Act that we mentioned from chapter 14, with CFOs taking the central role in overseeing those corporate compliance with the act of reestablishing public trust. So CFOs must look outward and be very business focused. And a lot of times those CFOs are promoting strategic finance and encouraging finance staff to be team players who really work closely with business units to achieve those corporate goals. So that's like a main focus for CFOs. And then just to kind of end on something I feel like is pretty interesting. Your book kind of talks about the competition among our largest securities exchanges has kind of changed the composition of the financial marketplace. So we've got the New York Stock Exchange, the NASDAQ, and they kind of went head to head in the United States. The New York Stock Exchange became a for-profit company, and then it expanded by merging with some other firms or other exchanges, if you will. And then NASDAQ also expanded by acquiring its own another exchange and buying quite a bit of stake. I think like 25% of stake or something in the London Stock Exchange. So just some fun facts when it comes to the stock exchanges. And I love playing around with stocks. I think it's fun. I'm no expert by any means, but I just think it's kind of cool and interesting to see what you can kind of do with that, and how, like, if you're really knowledgeable, there's, people that just do that for a living, and that's how they make money. And I just think that that is so cool, but it's very time consuming, and it's a huge learning curve. But there is an app and that I used to use, but because of my husband's job, I can't just find it. He's in the financial world. So, but it's called, if you just want to kind of dabble in the stocks, there's an app called Robinhood. And my students have loved it in the past, and I think it's kind of fun to play with. You can invest as much as like $5 or something. I haven't used it in years, but I know it's still out there. And so maybe something worth looking into if you want to kind of explore that area. But that is a wrap on chapter 16. So for chapters 15 and 16. And I hope you've enjoyed learning a little bit more about money and finance. But I hope y'all have a fab day, a week, or whatever day you want to be having right now. And I will be chatting with y'all soon.